All right. Good morning. Herzlich willkommen and welcome to the Big Tech Day 2022. Today here in the motor world and also at home in front of your screens. We have an exciting day ahead of us with a lot of things to explore, a lot of things to learn, and a lot of things to see as well. The Big Tech Days are a yearly conference on topics from science and IT, and throughout the day you will be hearing a variety of talks from topics such as quantum computing, AI, sports, and economics. Which brings us to our speaker for this talk, Dr. Jürgen Michels. He's the chief economist and head of research at BayernLB. He studied economics at the University of Bonn and received his PhD from the Goethe-Universität in Frankfurt. Afterwards, he worked as a research assistant at the Institute for International Economic Policies at the University of Bonn. He then joined Salt Oppenheim until 2002 as an economist, and until 2013 he worked as a, bear with me, capital market-oriented Euro area economist at Citigroup in London, since 2008 even as the chief Euro area economist. Now, as I've mentioned, he's the chief economist and head of research at BayernLB. In this talk, he will be talking about sources of the increase in inflation and also give us an outlook. He will talk about the consequences for economic developments and also financial conditions. Please hold your questions until the end or ask them in Slack during the talk. We will be answering them afterwards. And with that, Jürgen, please take it away.
Thanks very much, Jan, for the nice introduction. And it's a pleasure. It's the first time for me being here at the Big Tech Day. And when Christoph talked to me, I think, a year ago, so we could do something here, we thought, okay, as an economist, going to those techies, what can I contribute to this? And I said, yeah, there might be some things that might be interesting to this audience as well. And I hope that this is the case today. There's a topic, inflation. Everyone is confronted with it. And in a way, everyone is facing it, feeling it every day. And what I want to do is give you some background, how economists think about this. What is the difference between an increase in some prices and inflation? And what consequences this has on economic developments, and at the end of the day, where the impact on the economy and financing conditions comes through, what the central banks do with all of this. So I want to start with some basics. So a little formula here, Fisher's equation of exchange. So M, that's the amount of money being in circulation in the economy. So that's not just the notes and coins you have here, but everything what is created also from the financial system. And V, this is the velocity. So if you have a bill and that only stays with you, that bill does very little. If this bill goes around all the time, there can be lots of transactions done with the same thing. So it makes a difference if you have a high velocity or a low velocity. And this here, that's the sum of all transactions. Q is the quantity, so the real stuff, and P is the price for this. And if you sum this all up, then the amount of all of those transactions with the relative prices to this should sum up with the amount of money being in circulation. So it means if you have more money in, then obviously you can have an increase in Q, what is not that likely, but most of the time you create more price increases. And the name of inflation, that's the definition from the ECB. It says that's a broad increase in prices. So it's not just that the price for fuel goes up and the price for a computer goes down, then this sum here would not change. That means when the prices for fuel goes up that much, maybe that the other prices remain unchanged, or if all of those prices start to increase. And I think that's the phenomenon of inflation. So it's not about relative price changes, It's about an increase in all prices. Now, you can see me again with all the lamps on. Okay. Coming out of the dark, you see there is some increase in light. It might be inflationary as well. Now, having had this equation, central banks, which aim to have a certain level of inflation, and normally they define it as 2%. You can now debate why is 2% price stability. This is because you have lots of errors in measuring prices. So we have always very, very crude concepts to do so, and the central banks know if they go to this lower bound with interest rates at zero, then it's very hard to propel economic activity and get back this whole story to have the prices to increase again. So 2% is that what they aim to have. And after the financial crisis, we were in a situation where prices were below their target, and central banks went to a situation where they put interest rate at zero. The ECB put it into negative territory, and what they did was a massive expansion of their balance sheets. So what they hoped to do, going back to this equation here, to increase M, to have this price increases to come through again. So what they did, they increased their balance sheets. They bought lots of assets and did other stuff. And this is what happened, for example, here at the ECB with their balance sheet. So that was the beginning, and there we ended up. So it's quite a substantial increase. But you see in the first place that there's a big difference between the central bank's balance sheet and what actually comes into circulation. So this is M3. That's the broad aggregate of monetary conditions. So not just the central bank's money, but all of the stuff in what the financial sector creates. So that went up quite substantially. But here you have the price level. So nothing happened for a long period of time. So although there was lots of liquidity in the system, and we have seen several price increases, but not for the goods you purchase at the shop or when you go to a restaurant, but rather prices for real estate, for equities, for lots of other stuff, then went up. But it was not to that stuff what we measure in terms of consumer price inflation. And the other thing what happened is the more liquidity the central banks pumped in, the smaller amount of velocity was visible. So everyone got this, but they didn't know what to do with all that stuff. So it stood. In some cases, the banks got it, and they brought it back to the central bank again. So it was not in circulation. And therefore, that was one of the major reasons that nothing happened for a long time. Now, we went through this for many years, realized that all the efforts of the central banks to get inflation back again, to increase it again, did not work. And then the pandemic came. And we had lots of distortions in the global supply chains, and that led to some problems. So if you have a good not available, you're willing to pay more for this. And a good not available, that was really the case here. You see, it's the New York Fed. They looked at several indicators showing how the global supply chains work. And they found out that after many years of more or less little problems here, there were huge distortions coming, and delivery times, they increased a lot. So you had lots of goods not available. Have in mind, there's lots of liquidity, lots of money there that people theoretically could spend on this. So you were able to pay more for many things. Now, the question is not only if a consumer, if a household is able to spend more in the amount of how much money the central bank pumped in the system, it has something to do with your income as well. And if you look at the US, take the example here, that is what happened through the pandemic. The disposable income, so what a household has after taxes. Despite the fact that unemployment went through the roof, so the income from your labor source that went down, households had more because you got lots of checks from the government. So in the situation where, remember, we did not have the stuff available because of the disruptions of the supply chains. The households had lots of stuff to spend. And if you look here, that's again, so if you have more to spend, your savings ratio goes up. You see this here. Yeah? The shops were closed, could not spend anything, you put it on hold. And then there was a time when it started again. Some things were available, you could go out again, the shops opened, and you were willing to spend. And that went then to a huge surge in the personal consumption. So what we had then during this episode was a clash of supply-side restrictions and a huge increase in demand. And that was not just the case in the US. We had it in Asia. We had it all over the place. So that happened. Now, at the beginning of this year, we thought things would improve because despite the zero-COVID policy in China, there were signals that supply channels were healed again and we went back to a more normal development. And on top of this, looking here at the income situation, there was nothing added on this. So we hope that all of this, what we have seen with prices, that it was just a temporary factor. But then the war came in and led to another thing, namely an increase in energy prices. So these energy prices surged here like crazy. We have other things, come to this later, like industrial prices, it's steel and copper and stuff that went down recently again because, coming to this later, markets fear now that all what happens now puts us into a recession and therefore you don't need these goods in the future, so the prices go down again. But because of the constraints in production, we saw that we have this massive increase in raw material prices, mainly for energy, but also for food products or agricultural products. And when you look at the companies, they face this. So they face a massive increase in prices for intermediate goods here. Yeah, lots of goods in between, so semiconductors would be part of this as well. We had this as a shortage factor as well. But all of those other things went up quite big time. So the companies now face these price increases and they try to pass this on to their customers. That happens within the industry. And you see here, those who had this huge increase in intermediate goods were not also always able to put this through to their clients again. So if you're a capital goods producer or a consumer goods producer, you only get part of the price increases what a kind of a supplier at an earlier stage in this chain got. And when you want now to see how this comes to the consumer, that's now a European perspective, you can see it through a different way. We have here the imported prices, we have the producer prices, and we have consumer prices. And most of those goods who went up were, of course, imported. We have oil, we have all of these other raw material prices that came in from abroad, plus we had a depreciation of the currency. So the euro is now around parity against the dollar. When we started this, we were around 120. So on top of the increase in the oil price, we got as well, on top of this, the increase in the price of what we have to pay in Europe for this. So that all contributed to that. And at the end of the day, we saw this increase in inflation, mainly this broad basket. And this is here. Yeah? In the euro area now, we are at 8.6% year on year. So remember this inflation thing, it's the increase of the prices, and we measure this in a moving 12-month target, or 12-month window. So we now have all of those increases in, and part of it comparing still a period where you had falling prices for some goods last year, which you compare now with the increase now. So this is a really big figure. And what we try to do is to get not overexcited. We had always periods, as you see here, when energy prices, which are much more volatile than other prices, fluctuate a lot. So for central bankers, they say, okay, we can look at this, but we do not get carried away if we react to some noise. So they create a thing what is called core inflation. And the core inflation, you exclude the prices for energy and unprocessed food. And this is normally less volatile. And when you see that something goes up there, then it looks really, okay, it's not a short-term thing, it's something longer lasting what comes through. And exactly that happened. And one reason why this happened is that economics and the way how you react, if you want to buy something, what price you're willing to pay, is about the expectations. What is expected to happen with the price of that good in the future? And here we have only limited kind of sources and limited measures to think about this. So we can make surveys among the consumers. We can ask them, what do you think happens with prices in 12 months' time? And the European Commission does this every month. They ask a bunch of people, what do you think is going to happen? And we see with the fact that the prices go up, they expect, oh, there's something coming through, that this continues in the future. So it's not always rational that you look through, okay, I have all the stats, I have all the information, I look at the commodity prices, see that the price for steel, for lumber comes down again, and therefore I'm more relaxed when I want to build a house or so. No, you see it's going up right now, and have this kind of adaptation in that what happened to kind of point this into the future as well. So we see this broad-based increase here, what has not happened for a long time. There are other ways to measure this. One is to ask professional forecasters, guys like me, where the ECB does this survey every quarter, every month, and they come through and say, okay, you have much more information. You look in a kind of systemic way for this, apart from making many mistakes as others as well. And there again, you see this is going up. But in contrast to that's now the medium-term outlook. So they ask, where do you think is inflation in 5 years' time? Having in mind that we have the pledge from the central bank saying we want to have this as 2%. Now, you see this is going up quite significantly, but we are not at 8 or 9%, we are now at the peak at around 2.5%. And that's where the ECB, when you hear this sometimes, they are talking about the de-anchoring of inflation expectations. So they want to have something around 2. When it goes too high, you see that the whole machinery is coming in and it might get out of control. The other way is doing this through measurements on financial instruments. You have inflation-linked bonds, and you can see then the price, what you pay for this, or what is priced in the expectation for inflation in 5 years' time, what comes in as well. So you see here, this is this one here, that goes up as well, again now around 2.5%. You have similar figures in the US, it's a bit higher. So you see this increase in inflation expectations, and therefore the risk that you have a broad-based and lasting increase in inflation is much larger. So if you're now an employee and you see the prices go up, what would you like to have? An increase of your wages, an increase of your salaries. And normally that happens in a period where the labor market is quite tight. And you have this as the Phillips equation. Normally you say that the lower the unemployment rate, that the higher the wage increases. And about this Phillips rate, it's a debate about the last decade, that we have not seen this relationship to work. We had relatively tight labor markets all over the place, but wages did not go up. It has to do with globalization, lots of things coming in there, but simply it did not happen. So there was a debate about, is Phillips dead? Is the Phillips curve dead? We said, oh, okay, maybe that he's sleeping. And now we see that with the unemployment rate, that's now the example from the US, that wages start to increase again. You may be puzzled by these huge moves in nominal wages here in the US. That has to do that in the pandemic recession, lots of guys with lower paid jobs were out of the labor force. Therefore, they were not counted, and the average earnings went up. And then they came back again, and you had this kind of offsetting effect again. So that was what happened here. But now you see there is an increase. You have a shortage of labor, you're willing to pay more, plus you have the increase in inflation and inflation expectation as well. that what you see here, with inflation going up, everyone wants to have a compensation for this, so you get into this impact of increasing prices. So that's what happened in the US. Now looking to Europe, we have, if you look at the figures here, we have much smaller increases in wages so far. That has to do that compared to the US, the economic situation here is simply weaker. We have not that tight labor market. Again, comparison in the US for one guy looking for a job, there are 2 vacancies at the moment. So that is very unusual. So in Europe, we have it more or less the other way around. So you have 1 vacancy and 2 looking for it. So that's a kind of a different thing. But nevertheless, you see now also in Europe that the things are increasing and people want to have some compensation, and therefore there is some risk that we get in a wage price spiral here as well. Now the first thing what I want to talk now is about the consequences from these increases. What I mentioned earlier is that we have the increase particularly in prices for energy and food. And the OECD, they looked at households with the different income buckets. And they compared the 20% richest with the 20% with the lowest income. And you see that the change, and they had here only the figure up to the 1st of April, the change in the prices for food and energy led to an increase, taking the example here from the Netherlands, led to an increase of their expenditure of a low-income household from almost 8.5–9%, whereas a household which is in the highest bucket only had an increase by 6%. And that explains that the low-income households simply have a higher rate of consumption. If you have a high income, you have lots of saving, and therefore all of those increases in prices, you don't care that much as a low-income household does. So therefore, there is a kind of a social aspect with this. With higher inflation, you hit the poorer much more than the rich. But as we see now, for the example here in Germany, actually you hit everyone. Here, that's from the GfK, they look at the consumer sentiment. And this had its kind of a low point during the pandemic. But then we realized, okay, masks are not that great, but there's a way out of this again. So it was an improvement in the sentiment amongst the consumers pretty quickly. This time, yeah, it's kind of different. We came down quite substantially again, not just because there is this fear that you might lose your job or shops are closed or whatever, also that you see that your purchasing power is going away. And you see this, I hope you can see this, in this chart here as well. So that's for Germany, that's the savings rate. So similar to that what we've seen earlier for the US, where the savings went up during the pandemic because everyone was forced to save because he couldn't spend it, is now coming down again. So you're able to spend it again, what is a good thing. But what is interesting is this kind of split here between the nominal expenditure and the real ones. I want to make this sure with one example. If you consume 500 kilometers, you have a fuel combustion engine, and you drive 500 kilometers a month. That's your real consumption. The nominal expenditure for this was before 70 euros. That's the nominal. So your real consumption would stay the same, 500 kilometers. But now your nominal consumption, doing the same thing, would go up to 130. So that's what you see here. Yeah, you have this discrepancy. That nominal consumption is going up, but the real one is coming down. So you see there the loss of purchasing power, what is caused by this increase in inflation. So putting now all of those things together, we have this loss of purchasing power, we have this high inflation being there for a while, we have some buckets now where things go down again. We come to the conclusion that we will stay in a kind of high inflationary environment for a while, but with less savings. This is going down, And you may have now booked your holiday, spend a lot with this, and you get now your gas bill at some stage. So far you could do everything. You go to the restaurant, everything could continue. But at some stage you realize, oh, it's gone. And therefore, the ability to spend for another price increase is much smaller than it used to be. So what we see now is that this kind of loss of purchasing power will dampen economic activity, and therefore we see that here again, that's for the US, the Euro and Germany, after a large rebound we had after the pandemic, things went well. We now got in the phase of very, very weak growth. And I haven't talked about the war and other things at that stage, simply because also of this increase in inflation. What is likely to stay high? We think it's coming down. It has to do with base effects. I talked about this 12-month window, but also because of the fact that it will be even harder to pass on increases in prices that are not energy. And by the way, we think that oil prices and some things are likely to come down, at least in the 12-month horizon. Now, one thing I want to address in the kind of the impact what all could happen in the longer run, and what might be forces that keep inflation from a structural perspective higher in the future. We now all change our supply chains. We try to have different sources. That has to do with the fact also that with the 24th of February, the world has changed. We do not go back to square one that we get cheap gas from Russia. We also have our doubts about the relationships to China. So we have to think where we get the stuff from. We have to have higher storage. So all this costs something, and you want to pass this on to your clients at some stage. That is one thing that lifts price pressure over time. And we start now to pay more for national security. So we had the peace dividend at some stage where we could reduce the expenditure for the army, for weapon systems, etc. And now we spend this again. And this, in the first place, is not productive. We spend for something that does not give us an extra computer, an extra croissant, or something like else. It just gives us more security. We are forced to do this. We can debate about this, but we pay this. And there might be productivity gains. If I look to Silicon Valley, where I create new weapon systems that might help to have more interaction between drones and mobility things, there could be lots of things where you get from the technology, from the defense to the more private sector. But if you just order some bombers, some fighters from the US here that are produced in the US, we do not have any gain in productivity here. It's just extra expenditure. If you get cannons for some tanks, it's metal, it's consumption, it's nothing else, it's gone. If you shoot it, it's gone. And therefore we do lots of stuff that is not productive. Now we try to offset this, and there are also the changes in the business model and all this. There are lots of things we want to counteract, and I think they go in the right direction. But again, if I want to spend more now from public money or for another stuff into digitalization, into decarbonization, this is good. And I think that will help us as an economy, it helps us as a society, but it costs something as well. And the way we measure GDP, the way we measure inflation, I think at the end of the day, all of those factors that come in here will reduce growth over time and have more inflationary pressure, plus the fact that all of the expenditures that are taken now from the government at some stage probably come back in the form of higher taxes. And part of this will be higher consumer taxes, so the VAT will go up, and these are also, again, factors that increase inflation over time. Now, with all of this here, and I talked about loss of purchasing power and all this, the central banks reacted. So they were happy to have all of those liquidity out, all of these things running, and it did not work, and they were sometimes frustrated about this, and now they see, okay, it's happening. And what we have now, it's a thing that we have not seen for a long time, that central banks around the globe start to increase interest rates. So if you want to fund something, it's getting more expensive. And this is really unseen for a long time. It's not just the US central bank, it's not just the ECB, that's not in here as so far, because they only do it the first time next week. So all of them go up. And all over the place, if you want to fund something, it's more expensive. And we have seen this here. Actually, it's happening right now. On financial markets, you expect what they might do in the future. And what I mentioned earlier, this thing about inflation expectations, that also plays a role when you look at interest rates. So taking the example of the US. So these are the nominal yields. So for US government bonds, what they have to pay there. And you see, this is the real one, these are the nominal ones. Yet, first we'll hear a big increase in the nominal ones. That was the period where market participants said that inflation expectations go up. So that was the main driver for this increase in 10-year bond yields. What also fed then through in an increase if you want to fund your company on financial markets, or at the end of the day, if you go to a bank and want a loan. That's all the same. That's the origin. So that went up. And this took a while before they realized, okay, this real yield, what you could say it's a kind of the discounted value of the expected interest rates from the central banks over this 10-year period, that this went up as well. Up to this point, so we have seen already substantial increases of hikes by the Fed. And recently, despite this increase in inflation right now, they think that with the measures taken by the central bank, that this probably will contribute to a slowdown in the US economy, probably a recession. That the Fed at some stage will bring down their interest rates again. So we, for example, think that they continue to increase for a while with another 175 basis points to come up till the end of this year, but then to go down with rates in the second half of next year. So this is this expectation bit what comes in here. So looking at the euro area, again, we have not done anything here from the central bank, but partly we follow that what happens in the US, because this is the global leader on financial markets, but also we have some of our own life, and there the expectations of the ECB came back recently as well. With this happening, I want to show here, we have this change in financing conditions. So financing conditions, this is here, this 10-year treasury yield. Again, what is the government paying? That's the kind of the risk-free asset. But everything else, when it comes to households, to companies, there is more involved with risk. In this financing condition stuff, you have the equity markets in, you have the spreads what a company has to pay on top of the risk-free stuff for their funding. And you see that this tightened quite a bit. So we are at the highest levels since 2012, since a decade again. So every funding, everything you want to do will be more expensive than it used to be. And that has not only a thing to, let's say, consumption or housing investment if you want to buy a house, it has also something to do if you want to go into new innovation. If you look at the venture capital to the private equity sphere, they were flooded with cheap money, as well as the equity markets in recent years, and this has all changed right now. So we get a much more difficult environment to do of all of those big things you want to have in the future in terms of funding in new digital infrastructure, going to innovation, going for a decarbonization of the economy. It's simply more expensive than it used to be. And I think that's what is visible in this tightening here, and we're probably not at the end yet. When we now come to the situation in Europe, it's always a bit more complicated than in other parts of the world. So if you look at this ECB statements recently, they said, yes, we're going to increase interest rates. Oops. We're going to increase interest rates from July onwards. But then they had another emergency meeting the week thereafter where they talked about fragmentation. So with this increase in interest rates, you also make more visible that different countries have different starting points. That a country that has a huge amount of debt is probably more exposed to an increase in interest rates than a country with a small amount of debt. So compare Italy and Germany. And in the extreme case, we have seen this in the government debt crisis, where the spread between what you pay, or the interest rate for a 10-year Italian government bond and a 10-year German government bond was as high as 6%, 600 basis points. So then we had this whatever it takes speech of Mr. Draghi. Yeah, we went down all the way, and everyone was happy. The ECB was sponsoring this. Nobody really cared about that. I have to say the Italians did some things really good, because they realized, okay, now my rates are very low, and it's easy to fund not just for 5 years or 6 years, we do it for 10, 15, 20 years. So that's a good thing. They don't have to come back now to renew all of their debt obligations right now immediately, so they are much more relaxed in terms of interest rates increases, but nevertheless it plays a role. And the market is still kind of thinking, does that really work? And unfortunately, we have not made any progress in Europe to have a combination, also at the fiscal level, how to deal with the discrepancies we have in this monetary union. We left it all to the central bank to deal with it, and now the central bank has to increase interest rates to calm down demand, to prevent inflation and inflation expectations to increase further, to have further losses of purchasing power, to have further disequality between the rich and the poor. If you want to stop this, you have to go up with interest rates. But now you see here, if we do this, market's getting nervous, and we might get back to all of this debate, is the euro breaking up and everything like this. So they come up with another kind of instrument, which called it the anti-fragmentation tool. We don't know what it will be, but they have to define something, and they say it's big, and it should sort out everything. And you know that when you say something to this, like this, to financial market participants, they want to see it. And probably we will go to some episodes of another rounds of, I think, turbulences on financial markets, particularly in Europe, coming up. Now, before I come to the end, I just want to show you some numbers, what we now expect, what will be happening in coming years. And being in this environment like this, doing some forecasts for specific points in the future it's dangerous anyway. With the question, do we get gas or don't we get gas from Russia, it's even more complicated. But maybe a word before I go to these figures. If this gas issue happens, if we would not get it, we probably go into, I would say, a deep recession here in Germany, and we may see that prices would go through the roof, at least for these selected items on energy. But if it really happens, if you know we go to a recession, many people will lose their jobs. Central bankers and others will also realize, what we have seen before, that you don't have the income, you don't have the purchasing power to pay more for a restaurant visit and for many other things. So although this might have another spike in inflation, which is likely to be dramatical, I think the longer term and medium term impact from such an additional move would be deflationary, because you reduce so much of purchasing power that would probably lead to a collapse of economic activity, and then in the aftermath of this, inflation is likely to come down pretty big time. Now, without that, we are already a bit more pessimistic than others are. We only have, looking for Germany, growth around 1%. Other institutes are still around 2–2.5% for next year. We have a recession in the US, and in all of the areas we have pretty high inflation this year and coming down next year, but still way above, on average, these 2% targets, what the central banks want to have. And over time, we think some of those short-term factors will kind of come down again and reduce itself. We see that the structural issues are likely to stay, and that we, coming from a decade of inflation rates between 0 and 2%, most of the time around 1% or so, we are now heading in a period where we probably will stay something between 2–2.5 in the next couple of years. In this environment, and that's now the consequences also for the financial market stuff, as I said, we expect interest rates to go up, 170 basis points from the Fed up to the end of the year, and also from the ECB. They have not done anything yet. They had said, and that's very unusual for central bankers, they will do 25 basis points in July, and thereafter we only have to guess. What we guess is that they come up with significant increases. We have built in 3 50 basis point hikes in September, October, and December. And it might be that we may get even 75 or 100 already in September, then probably smaller steps afterward. So all of this, the consequences of high inflation is that central bankers, in contrast to the pandemic, where we had the central bankers to support economic activity. Yeah, they came up with a huge amount of liquidity. They had interest rates low. They do not or they are not in a position now to support the economy. And I think that's the first time really since the financial crisis that we are in this situation. Before, central bankers were always there because they had no conflict in their kind of function, which means I want to have, for the Fed it's explicit, I want to have unemployment low and inflation low. That's their target. If you go now to a situation and something happens, when inflation is too low and unemployment is too high, it's easy. Yeah? You can do expansion of monetary policy. Now, if inflation is way too high, and regardless where the unemployment rate is, you have to deal with this inflation issue. And therefore, they are not there to help. They are not here to help financial markets. They are not here to help the economy. And therefore, we're probably in an environment where things will remain tough, remaining financing conditions. Nevertheless, if you look, and this is the 10-year Treasury forecast here for the developments going forward, with this inflation pressure at some stage coming down, there's expectations for inflation that are likely to come down, and the expectations what the central banks do in the future will come down as well. And therefore, we see that there is some relaxing in this. And therefore, well, if we went through the recession, things are starting to improve again somewhat, that financial markets are likely to improve again. But nevertheless, we are in an environment which, in contrast to that, what we have seen for many, many years, central bankers are not there only to provide liquidity in unlimited fashion, so to speak, but this is becoming a scarce issue again. And the main reason for this is that inflation, after many, many years, is back. I hoped I gave you some of the sources for this, that it was understandable. I think from the equation point of view, you're much better than me anyway, but to give you some background on this, about the sources of inflation, the impact it has on the economy, and mainly the impact it has on the economy through the reaction of central bankers that make a big impact on the developments of financial conditions. That's from my side, and if you have questions, I'm happy to get them. Thank you very much.
So thank you very much for this very interesting talk. I think you brought the topic down to us in a way I could understand that, and I'm not that versed, let's put it that way. Well, a small thank you for you. It's chocolates and cars. I mean,
thank you very much.
The spot here.
Thank you.
And now we can open up the room for questions, and also, of course, on Slack. We'll get to those in a minute. So please just raise your hand, and we'll get a microphone to you in a second. Let's start right at the front, first hand.
Henry Ford once said that if we would know how the monetary system works, we would have a revolution tomorrow. Why is it that we know so little about how money is being created and how money is getting into the market? And do you think there is a system behind it that, especially we don't learn it at universities? Because for me, for instance, I studied economics, and to be honest, I know little about how the European Bank is distributing money in the market. And lately I read that we have an increase of the amount of money in the last 10 years by 7, multiplied by 7. which means inflation has to be there, obviously, because we have 7 times more money in the market. So why do we know so little about all these topics?
There's lots of research done on all of those issues for many, many years, but it was more about the question how to bring down inflation. And we always had the thought that it would be some kind of symmetry in this, that bringing something down, and if you want to reverse it, that would be easy. But I think that really underestimates what happens in the economy. And my personal feeling is that we, for a long time, underestimated what happened during the financial crisis, how much the bank balance sheets, because one thing is what the central bank does, and the other thing is what the private credit creation is done, what happened on that front. Because we went since then to a long period of balance sheet repair of many of those institutions, and we went to a phase also implemented from central banks, but not from the monetary policy guys of the central bank, but from the financial markets or bank regulators at the central bank. And they came up with a huge amount of extra regulation, what you could do, what you could not do, and that led to very, very strange developments. And I think we lots of those things we do not understand rightly. And you had often the case that you looked what came from the ECB. On the one hand, you had the monetary policy guys having their foot full on the throttle, and the guys from the regulatory arm, from the supervisory arm, the more they went through the throttle, the more the other guys went on the brake. And I think that partly explains why we went through this situation. But the other thing is also that we do have data, but not the best data in seeing how things are correlated on a global way. And I think that has increased substantially in recent years. And there are some studies coming in what impact from globalization, from cheap work had on the pricing developments in many countries. But we're still at the beginning. And we all wonder, in many countries where you had some tight labor markets, that this did not go through into a development of an increase in wages. That was the whole Phillips curve discussion. I think all of those things come together, and we look at several things there, but it's still puzzling. And it's not engineering. We don't know, you put there the button and things happen in that fashion. It's about the behavior of households, the behavior of individuals, and I think that has changed also over time, and most of the time I think we have not had the right feeling about what inflation really means. I know that's an incomplete answer, but giving some color to it.
Thank you. More questions, maybe from the back of the room a bit, so everybody feels included. Then I think we have a question on Slack, maybe.
So on Slack, we had a question that got a lot of attention. What to expect for the housing market? Will prices fall as the other asset classes?
So we have seen a massive increase. So looking at the mortgage rates in Germany, they increased by 2 percentage points within 2-3 months. So every new buyer is now confronted with much higher financing costs in combination with an increase in the in building prices as well. So I think there will be a slowdown in construction activity, and there will be a slowdown in prices for houses over time, but in a moderate fashion, because I don't think that we get into a situation of fire sales. Fire sales could happen through 2 channels. The one is that the guys that already bought houses, that they face a substantial increase in their funding conditions. But the 3% what you would pay for a mortgage rate now is more or less the same than you paid for your 10-year loan 10 years ago. And when you have to refund this, you are not faced by a significant increase of your funding costs. You're more or less in the same area. It becomes a problem if the guys that 2 or 3 years ago, they funded their house with 1% interest rate. In 7, 8 years, if you still are at 3%, they have a problem. They have a substantial problem. And the other thing where you could have a sell-off on the living space stuff would be if we have a substantial increase in unemployment. So if we go to this scenario, we don't get gas, we go to a deep recession, then probably this combination of high interest rates and the high unemployment would lead also to a crash. And one thing what we see, and that's more for commercial real estate, prices come always, or you can measure prices when you have a transaction. And what happens right now, many transactions simply do not take place. Everyone is waiting. And therefore it simply takes a while before we can see anything to happen in the prices because you don't have a measure point. So my feeling is that probably next year we'll see commercial real estate prices coming down. And on the retail side, so the normal price for a house, for flat, that there the increase that we had sometimes double-digit in the last couple of years will slow down massively, but I think it's more that we enter a period of stagnation. In some areas, of course, prices will fall as well. But it's not like forecasting now, there's a burst of a bubble and we see 10, 20% fall in real estate prices anytime soon.
Thank you. Then I think we had a question in the back here.
Hi, thank you for the lovely talk. My thinking goes from the fact that our central banks have existed for quite a while now, and I imagine that they have quite a bit of experience with past situations, the past actions they took and how well they worked, the effects that they had. Now, from the graphs you've shown me and what you've said, I got the impression that we're in a situation that sounds a little bit unprecedented, and I was asking myself if, am I under the wrong impression here, or are our monetary policymakers now flying kind of blind? Or is my premise wrong, and in fact, kind of flying blind is basically the normal operation mode?
The last one is a good one. Looking back in history, this problem of inflation is not new. That was the normal world before we entered this period that started more or less at the beginning of the 90s, where we saw more or less 3 decades of inflation being very low and having lots of forces coming in. But you're completely right that central bankers, when we entered this period, also with negative interest rates and things like this, what I've always seen that, oh, this is not normal. But now if you look at the board of the ECB, so the overall 28 people there, there's one guy, Klaas Knot from the Netherlands, who has pushed the button interest rate increase once. That was 11 years ago. Yeah, we are out of that fashion. And in that circumstance, yes, it's a new experience for the central bankers itself. It's a new experience for many market participants. And I think this is something to learn again. But having an increase, what we might get in July from the Fed by 100 basis points, is unprecedented for the last couple of decades. But Paul Volcker once did in one move 400 basis points. So we were back in the 80s. That was not that abnormal at all. But we are now in a situation which is new because we have been in another regime for a long time. And I think we have to learn, not just the central bankers, every participant in the market, every trader, but also every treasurer at a firm, every household, how to cope with this new situation. And after many years, you can say, okay, they have not done that many things wrong. We will get in a period where there are mistakes, and these mistakes might have the consequence of, in the best case, a huge amount of volatility, and in the worst case, that we see that this system simply goes out of control. We have a significant increase in inflation, and that we then get some significant doubts about this monetary system we have at the moment. And we have done at BayernLB Research quite a few things in terms of research on Bitcoin and other things. That might be the time when there are doubts about the whole monetary system we have, and that there is a kind of a revolution coming up. I think we are far away from this switch to this kind of world, but it's a significant challenge we go through at the moment.
Thank you. And I think this is all the time we have for Q&A now. You're, of course, still free to discuss this talk on Slack. Maybe Jürgen will join you there as well. We'll see. But apart from that, we'll have the next talk in 10 minutes' time. I hope you all enjoyed this and have a nice day. Thank you.